Hey everyone, and welcome to Case by Case webinar by Smallcase in association with Aurum Capital. And today we have a very serious veteran in the industry of investments. And I'm so glad for you all to actually meet and get to know and have this incredible session from Jiten Parmar from Aurum Capital. Jiten, please say hi.
Hi.
So
Good evening,
talking
everyone.
about Jiten, Jiten is a serious veteran in actually doing investment. I'm sorry to cut you off before you said hi, but I'm also really excited to have you on the platform. I know you have a huge fan following, and the small investor in me is also very happy. So Jiten has been investing since like 1993, and he has started investing in the Indian markets in 2002. It shows that he's going a long way. Besides that, as a business student also, and the business ideologies that we all have, he is a very serious entrepreneur. So he had his own IT firm startup in the US. I'm right about this, right?
Yes,
You
yes, yeah.
had your own, yeah, an IT firm in the US. So this gives us a lot of aspirations and inspirations for the younger ones, the younger investors like us to look up to as a role model in Jiten. So thank you so much for your time to come on board. I know it's a Saturday. I tell this to everyone because it's hard to actually have a session on Saturday. But I also know that you've taken a lot of other sessions and webinars based on your experience. So thank you so much for taking the time to come on board Small Case and take the session for everybody. It is really helpful for everybody. And today, Jiten is talking about a very important topic, that is investing in cyclicals. So before I go on and on, Jiten, the webinar is all yours. Thank you so much for coming.
Hey, thanks, Abel. And thank you all for joining on a Saturday afternoon. And I hope I will share something which will be of interest to all the subscribers who have joined. A little bit about Aurum Capital. I mean, we are a research analyst and an investment advisory firm. And we are in the research analyst profession since 2018. Prior to that, I have almost a 3-decade experience in investing. So let's delve right into the topic, investing in cyclicals. So the disclaimers before we start. So this is what I told you just now. We are a SEBI registered research analyst firm. We will be taking some case studies in this presentation, and everything is obviously for education purposes. None of these should be taken as recommendations. If at all, I will share any names. Most probably I will not share the name because the name will not be important. The studying of a particular company, the case will be more important rather than the name. So this is the disclaimer. This is briefly about our firm. aurumcapital.in is where you can find more info. So let's start. So as I say, investing is much more about psychology and history than science. I mean, science in the sense that not the scientific field, but science means studying companies' balance sheet, studying financials about the company, understanding about the industry. That's the science part. But I believe that is important, but much more important is psychology and history. And I will share through examples why I say so. So why it's important to understand cyclicals? The primary reason to understand cyclicals is that though many people have an aversion to cyclicals, you have to understand that 90% of listed companies are cyclical. The degrees may vary, but I still believe that they are cyclical. The economy is also cyclical. So obviously, companies, stock market will be cyclical. So if you can understand, what happens during cycles, that will make us better investors. Though a lot of people might not invest into the deep cyclicals, as I call them, like commodity cyclicals. One may very much, decide not to invest in that. That is fine. but understanding cyclicality is quite important, I believe, if one is an investor or one wants to be a good investor. Quickly onto the investment philosophy at Aurum Capital and our personal investment philosophy, me and Nitin, my partner. So basically, we are value-oriented, we are patient and long-term investors. At the same time, there are a lot of opportunistic plays the market throws, and so cyclical commodity whole segment is basically sort of an opportunistic play, I would rather say that. And we have been doing this for a very long time, and at the same time, the focus again, even in cyclical commodity stocks, is value oriented. The basis is very value oriented. So we are very mindful of what we want to pay for a stock. A stock means an asset. So what we want to pay for asset, we are very, very particular about. So at Aurum Capital, these are the 4 or 5 things we focus on: value plus growth at a reasonable time, price, cyclical commodity stocks, special situations, turnaround opportunities, and mispriced bets. Some of them might overlap, obviously, but today we will be talking about cyclical commodity stocks, and this presentation is towards that. So before we go on to this, for any stock for us to consider or buy in a portfolio, these are the things we look at. I mean, investing obviously requires a lot of effort, and especially when you are a research analyst, you have to do a lot more work than if I'm doing something for my own portfolio. So these are the checks and balances we have, and the checklist we have before we consider any stocks fit to be added to the portfolio. So at least 5 years of annual reports is what we look at, because this 5 years, minimum 5 years of annual reports will give you a clear picture of a lot of things about the management, about the company, whether they are, performing to the potential which they lay out in their annual report. Again, this will also tell about the future potential about the stock, whether whether this company can grow. I mean, stocks are to be bought on future potential, not on current situation. The current situation might be priced in for a lot of stocks. And cyclicals, yes, current situation, the current price might not be factoring in future performance, but for a lot of other stocks, the price will reflect what the company is doing now. For it to be a winner, you need to be able to gauge into the future, to be so as to say. Again, promoter holding and pledging we look at. We need to be very comfortable with that. Pledging, promoters who have pledged the majority of their shares is something which we avoid most of the times. Management quality should be above average. We definitely don't compromise on corporate governance. We are very, very particular about operating cash flows. Debt levels, again, it can work both ways. In a good cycle, a company with a slightly heavier debt might actually outperform a lot. But the debt level should not be unmanageable. Competition, who are the peers in the sector, and where this company stands vis-a-vis competition. Scuttlebutt, this is very, very important. Speaking with external sources like suppliers, dealers, customer, past and current employees. This will tell a lot about the culture of the company. Whenever con call transcripts are available, we will look at least 3 years of con call transcripts. What annual report tells you is sort of an annual picture. Con call will tell you every quarter. And then you can build a more correct picture. Con call along with annual reports are 2 of the important things we look at. pricing power, whether the company has pricing power, what are the entry barriers in the industry they are, what is their capacity utilization, whether they have done any capex which will play out in the future, so operating leverage, whether the company has scale, can it scale? I mean, a lot of companies are small companies. Does the management have the potential to scale and take it to be a, make it a large company? Well, and most important, I mean, after all this, we can find a lot of qualities, these qualities in a lot of companies, but then valuations are not supportive. So we are very particular about valuations. We would want a lot of these things at good valuations. So that is what we look at when we evaluate a stock. So in cyclical commodity stock investing, there can be two strategies. One is a cyclical turnaround strategy, where you would invest in companies where the turnaround has already happened and is visible, or you can play a cyclical contra-bad strategy, where you would buy when almost, everything is really bad in that particular sector, industry. But obviously the price of the stocks will be very, very attractive. So two ways we can play this, and I will explain in detail about these two as we go along in the presentation. So this is something which during the Investor Carnival in 2017, I had put out this analogy, and it was widely quoted across. But cyclical commodity investing is like going to a pub. So I say enter during happy hours, when probably you will get a buy one get one free, and leave at midnight or maybe around 1 a.m. when the party is in full swing. Even if you stay late, be near the door, or you might end up paying the bill for others too. And I'll explain why. So this is the typical commodity price, how the cycle moves. It's a perfect sine wave sort of. And you will be astonished, and a lot of companies move in these sine waves, regarding their performance or even regarding their prices, especially where the cyclicality is involved. So very simple, here a lot of capacities come in, and so demand, is far lower than the supply which is coming, and then there is a correction. Along this way, you will see, supplies going out, some plants closing, and then things stabilize. This you can say is the price probably of the product or something. So so here price will go down. Somewhere here it will stabilize. It might not be like this. It could be a flat also for a while. But here is where the worst is kind of getting over. Now this period is something which obviously one can only know in hindsight. But basically tracking demand and supply will tell you this. And then when situation is where demand becomes better than the supply, this is when you have the boom. So typically, most cyclical companies will move in these ways. Again, as I said, it will not be a perfect sign. I mean, there will be, this could be, it will not, see, when we draw this line, we are drawing it straight, but it will be zigzag like this, while going up, while going down also. But if you elongate it enough, you will see a sine wave. This is a very important slide. So the key is where to buy. This is the place not to buy unless you are a momentum investor, where you might buy here, you're going to get here, out here, and that's a different story. But any good value investor would probably avoid buying here. They would either buy here. If you are very patient, you can hold for some time, or one can buy here. So this is the basically the commodity price cycle. So how do we evaluate stocks in cyclicals? So triggers will show up. I will give you a good example. In 2015, for example, sugar. Sugar is a cyclical which I played that time, and some triggers basically became evident. So we had a bad monsoon. So obviously our sugar, acreage was going to go down, and our production was going to go down. And at the same time, I think Brazil crop also failed. So there were two of the biggest sugar producers have problems. So what happens is the demand generally would not change, but the supply goes out or gets reduced. So that is like perfect time when you know that sugar prices will go up. Typical demand supply. So when this kind of trigger shows up, that is when you start looking at the sector and go about it. Basically, study the past cycles, study the production data, as I told you about this example in sugar. It was clear that production was going down. As demand obviously for a commodity like sugar will stay same, or every year it is increasing, right? Check for capacity. This is when we get into individual companies. What are the capacity utilization they are having? Check for capex. Again, during this, or rather, if I show this, this is where a lot of capex also comes in. So that gives you a signal that you need to lighten out or sell from the sector. When a lot of capacities come, basically supply will increase. So check for capex. When many companies announce capex, it is a great signal to be alert at least. Check the margins. Check price to book, current and historical during up cycle and down cycles. P is not a good parameter to invest in cyclical companies. I prefer price to book or replacement cost. So this is the evaluation part. Now investment process. This is something which we follow. Obviously, everybody can prepare their own approach. But what we do is prepare a list of stocks with the team. So let's say sugar. So you will have 15-20 names in sugar. So you shortlist a few, maybe at least 2-3 names if you have a wide enough basket. And personally, I have had more than 2-3 also. During my last play in sugar in 2015, I had 5 stocks. Again, so it's very individualized, but you should have at least 2-3 names is what I think. Use a basket approach for investing. This is very, very important. Stress test. Now, when you are investing, you are expecting certain things to happen. Okay, that might happen over the next 1 year, or sometimes it may take 2 years or more. So this stress test is very important. And that's where studying the balance sheet, past cycles become very important. Can this company survive another couple of years of downturn? What if things were not to improve? See, again, all this, I will show in case studies also. A lot of things, it will look very simple that, yeah, this is how it happens. But, every cycle, there will be some changes and you have to budget for that. So always, I always put a stress test that, can this company survive for another couple of years of downturn if things were not to improve? This is especially more important when we are doing contra-cyclicals, obviously. So another good signals many times you get is, there are, closure of companies or some companies going bust or some plants closing down. That could be a great signal to get interested in the sector. Continuing with the investment process, the things we look at, check insider buying, selling. All the good promoters, they generally have some sense of the cycles. and you will come to know in their past history, during when things are turning, they will be buying, and when they think that the peak is reached, or something close to peak or something, they will be selling. So that can give you great signals also. As I said before, don't look at PE. Excuse me. And I will show you some examples why not look at PE. Check if the company has cash management, manageable debt, as I talked about the stress test. And in contra-cyclicals, that's what I do. You start initial buying at the highest pessimism when everything is wrong. Companies are really doing badly. That is when I buy my first quantity, so that I can track that sector much more aggressively. And when I see some changes happening, that is when I would add. So basically, I will put my foot in the door at the highest pessimism levels, and really ramp up when I am seeing some changes or the cycle turning. This is what I generally do. So in the contra-cyclical strategy, you are buying when financial ratios are worst. EBITDA margins, ROEs are really down. Company might even be in a loss. So as I say, buy when PE is 60. This is just an example. I mean, this will not be true for all industries. But buy when PE is 60 and sell the same company when PE becomes 6. Again, it is very, very counterintuitive. And I'll show you with a very good example why I say so. Buy when sector is completely neglected and sell when it is hot. So typical example right now would be, so if you see metals last year, they were completely neglected. And all those who are following me on Twitter would have seen that, last year I had talked that, metals stocks are at very attractive levels. So valuations are very supportive. And when the cycle turns, we can do very well. And this is exactly what has happened last 6 months or so. And so last year, again, it was completely neglected. Nobody was talking about metals. There were no reports covering metal sector or stocks. And now you see what has happened. Everybody is talking about metal stocks. Everybody is coming up with reports. If you have that, then at least be alert is what I would say. You might not want to sell it because you don't know how long the cycle will last, but at least you have a strategy that I will deboard, because generally these kind of good times will not last forever. That is for sure. So for example, Tata Steel, it took more than a decade to come back to the previous highs. So if you are caught wrongly, then you just to get your price back, you are caught badly in the upcycle, and you bought in the upcycle, and if cycle changes, it might take 10 years also to get your price back. And if you're bought in a down cycle, you might not, they may still go down, but the period will not be very long, and if you are patient, you will definitely make money. So that is the difference. So just be very careful about all this. Basically these are all psychological things. When everybody is covering it, that tells you that there is greed on the street. So if you are invested, at least be alert. Have an exit strategy is what I would say. So coming back to contra-cyclicals, demand supply situation is not very good, and supply outstrips demand. So that's why the whole sector is down, right? So this is the time when you can start look, because you will get the best valuations then. If you understand companies, sectors, and understand the fact that there are cycles, and if you have learned from past history, past cycles, that things will mean revert. So basically a contrarian approach is required during the contra-cyclical strategy. But again, this can be a bit painful in the sense that you might be having periods where these stocks will do nothing or might still go down. If you understand it, you should be, willing to add more when it still goes down. But for that, you need to have a complete understanding of the sector and past cycles. So cyclical turnaround strategy is slightly different. That here we will buy only when we are sure that cycle is turning. So we will not buy at the bottom in this strategy. Obviously, we will buy slightly higher. It could be, prices can move very fast, maybe at double of the bottom or 3 times the bottom. But still it has a long way to go. So here EBITDA margins have started improving. You can see it in 1 or 2 results already, or ROEs again have started improving. Company might have narrowed the loss or come in profit. So this, and also you have some visibility for a period that that this cycle will last for at least a year or 2 years or something. So a lot of people ask me about steel right now. I said my answer is I don't know how long it will last. So even if I have it, I'm on alert. I'll definitely not buy it here. Whereas for something like cement, I know that the cycle looks good for another 2 years, 3 years. So that tells me that I can stay in this sector for much longer. And if things happen, what I envisage, these are the things will happen, and obviously price of the stocks will increase. So there are different types of cycles, different sectors. So you have to understand that. So in this cyclical turnaround, demand supply situation is improving. Prices of products have bottomed out and started showing uptick. So these are some of the factors will become visible, and this is one strategy also. So some examples of triggers which will show up and which will make you interested in a cyclical sector. Few examples of past where I have done this myself are put on display here. Sugar, we have already talked about that. Paper, again, what happened was largest producer of paper in India, which is Palarpur, built quite a few of their plants closed down because of the debt problems and all in 2015. And so all of a sudden, a lot of supply went out of the system, and we had a fantastic run in paper stocks. I will show some examples. Fertilizers, again, 2 failed monsoons and then a good year. So during the failed monsoons, you could have done some contra investing. And when there is a good monsoon, you can do the cyclical turnaround investing. So it depends on what, but a good monsoon after failed monsoon will definitely give a good momentum or a cycle turn for the fertilizer sector. Polyfilms, this is where I started taking this seriously. That was in 2010. In the Buffett cycle of polyfilms, there was a fantastic run, once in a decade kind of run, and prices of films doubled in like 6 months or so, without RM, the raw material prices improving. So fantastic profitability these companies had, and when these companies show good results, obviously prices go up. And so this was the first cycle I actually, I've been playing it, but without knowing it. This is when I started thinking about this and evolving this as a investing philosophy. So this was one of the first ones. I'll show you example in the example again what happened during that time. Chemicals, again, China measures for pollution control and closing of many units gave a fillip to Indian chemical companies, and also from the political angle you could sense that this particular government was protecting the Indian companies by using anti-dumping duty. So understanding that also helps a lot. So chemicals, we've had a dream run and must still continue for some time for sure, is what we think. metals mining, again, this happened in around 2015-16 is when actually the steel cycle started, to be honest. Chinese, again, same which pollution control in China was a theme for many cycles to turn in India. That's funny, but that's what had happened in the last many years. Cement, again, this is completely domestic sector because cement generally very difficult to import or export. So, but the focus on infra by the government, the government wanting to give a house to every Indian, and then you look at whether a lot of supply is coming in. There was not a case of lot of supply coming in. Obviously, there were a lot of NCLT resolutions, which so a lot of closed cement units got acquired by other ones, and they started production. But still, you generally there is a documents by the government telling that this is the CAGR which we will be having for it. So you can guess that supply, this much supply is coming in and this much is the demand. So when you know that supply is not coming as much as the demand growth is going to be there, that there will be a good cycle. So cement, again, we are seeing this. So entry is one thing, but I think exit is the most difficult and very important in this. As I gave you example of Tata Steel, you will find scores of examples where if you don't exit in time, you have to wait for very, very long to get your price back. And unfortunately, a lot of investors will not sell at a loss. That is the fact I've seen with many investors. So they will wait for 10 years. Now, these companies could be good companies, right? But they are caught in the wrong end of the cycle. So prices will come down. That's how it works. So we as investors should not get caught in the wrong end of the cycle is what I have been trying to make people understand over the last many years. So try to get out before the best earnings. Peak prices will always come before peak earnings is what I firmly believe. In most of the cases, this is what will happen. And again, a lot of it will be evident in hindsight. So, but there will be some signals which will tell you. And you need to, if you have made a lot of money, you need to deboard at some point in time is what I would say. Always understand that there are extraordinary earnings in upcycle. Never commit the folly of assuming these are normalized earnings and look at it with the PE lens. So somebody saying, some company is in tremendous upcycle and let's say making 100 rupees profit, and you see the price of 500, you say it's only at 5 PE. That is not right, I believe, because in normal times, this company probably makes only 20 rupees profits. So you have to strip out the extraordinary earnings and then look at it. And then historically, you have to see what is the valuation these companies have got. A lot of people make this folly of taking these extraordinary earnings, annualizing it, and applying a PE ratio to it. I think that's a big folly. What one should look at, I believe in employing a strategy like looking at price to book or replacement cost. This is much better way of planning your entries and exit. So one can employ a very simple strategy. One can employ a strategy like getting in at 0.2 to 0.5. In these markets, you might not get something at 0.2 very easily, unless it is in a really bad mess the cycle. But you definitely could get something at 0.5 of price to book or 0.4 or whatever, and get out at 1.2 to 1.6. Very simple. Of course, these companies, for example, Tata Steel right now is at twice to book this thing. So one needs to. So these are the times when one need to. I mean, I'm nothing against Tata Steel. I'm not envisaging a short in Tata Steel at all, or I mean. But I am just trying to give an example for education purpose that these are the times when I would say investors, okay, for momentum investors or momentum traders or traders, again the scenario is different for them. these things might not be important. But for serious investors, um, one should not invest when these things, I mean, they might still go. I mean, I'm not saying that Tata Steel will not go to 3 price to book, but your risk reward is not in favor. You don't have a margin of safety at these prices. So that is very, very important. All investments should be considered from a risk reward and margin of safety perspective. So this is very simple strategy one can employ. Try to estimate normal EBITDA margins by averaging them over down cycles and up cycles, and accordingly calibrate your entry and exit strategies. Some of the strategies which one can apply for playing cyclicals: and never repent. The price still goes up after you sell, as long as you have made very good returns. You made 4x, right? And it still goes double from there. That's fine, but you still have made 4x. So be happy with that. Maybe next time you try to, maximize it by employing some strategies like maybe reverse stop loss or something. But be happy with if you have made a lot of money or made a good return, because invariably it will happen that you will not be able to get out at the top. You will, and if you listen to me, you will never get out at the top. You will always get out before the top. But if you follow this, I'm very, very confident that you will not lose money. That is true, and make good returns. So some of the rules I follow: always make positional plays. These are not long-term plays. Your investing position in this particular theme should be clear that I'm not going to hold this for 10 years. I know that I will hold it for maybe 1 year, 2 years, 3 years, 4 years at the most, not more than that, depending on the cycle. But I will get out. Otherwise, prices will again come down, and you will lose a lot of your gains. And you'll be surprised. It will come to the same price you had paid, and whole cycle is gone away. Especially for contra investing, as I told, be ready to hold for a couple of years. Make sure portfolio allocation is adhered to. What I follow is never go more than 25% of your portfolio in a single deep cyclical sector. Deep cyclical sector means sectors which have heavy cyclicality, like steel or sugar and so on. Do not change the narrative just to hold on to the sector stock. What happens is when things are doing well, there will be a lot of new narratives which will come. There will be reports, they will suggest something, and you will get buyers, and you would want to hold on to the stock because something which has given you good return, you want to hold on and try to milk it to the max. So you will change the narrative. I am very, very cold to all this. I will not change the narrative. I bought this for a particular reason. I bought it for steel. I will stay in it for steel. When I think that it is coming to my exit criteria, I will sell it. That's fine if it goes still up. I would have made a lot of money. So just be detached, is what I would say. Again, obviously there will be some failures. There will be some sectors or some cycles which will not pan out the way you want it to be. When you realize it, you need to cut it. But my history has been that most of the sectors I've played, I mean, at least if you do it right, I mean, you can have at least 80 to 90% success ratio, which is good enough, more than good enough. So timing is very essential in this. We don't have to be, but at the same time, I mean, timing means you don't have to get in at the bottom and get out at the top. That is not required. We don't have to be exactly right. We are good even if we are approximately right. That is more than good. Don't have to get in at the bottom nor get out at the top. You should be able to get the general direction right, and don't mind leaving something on the table during exits. So what do we have to comprehend when we invest in stocks? Within stocks and sectors, you have to comprehend business cycle as well as market cycle. See, there will be a business cycle, and There will be a market cycle based on the sentiments at that point in time. A lot of times you will see that your company is doing very well, is in upcycle, but market is not paying for it. That could be for a host of reasons. Market has a mind of its own. So, and also another thing is, business cycle and market cycle might not coincide. A lot of times market run ahead of, business cycles. Market cycles generally run ahead of. So if something is not happening, maybe, market is telling you, market might be wrong or right, but it's telling you that, there will be, speed bumps in the future. Or currently maybe the market is telling us, despite all these lockdowns and all, the market is telling us that, there will be, normalcy in the future. Market will be right or wrong, we don't know, but market is telling us that. So market cycles again is something which we have to comprehend with. And one needs to make adjustment in investing accordingly. As I say, best price may come before best results, and worst price may come before worst results. So best price means best price to invest, top price, and worst price means the bottom price. Some other learnings we can just, basically some behavioral this thing. There are different strategies investing. Each may have its own merits. Choose the one that works for you. Always weigh, this is very, very important, always weigh investments from a risk, reward and margin of safety angle. So if you're buying something at, high risk, it might give you, you have to understand that, what is the margin of safety. If something can, fall 50% and give you 25% return, it's not worth it, is what I would say. Typically you would want that, my downside is maybe 20%, but my upside is, 60%. So that is a good risk reward ratio. Successful investor trade, always remove bias, rigidity. A lot of people are very rigid in their investment approach. It might work for them, but then they will be prepared to have periods where, your style will not work. And you might just have to sit out periods or underperform. But you have to understand that this is going to happen. When good times come, make it count. So as I said, when cycle turns, these are good times for the stocks and investors. So you make it count. Over the period, I've also used, developed or started applying some mechanisms where I can maximize my profits. So you can use trading profit production, or basically using reverse stop loss for riding the full wave or close to the top. One can do that. Good stock at a bad price may underperform bad stock at good price. This is what I have learned. I firmly believe that for a good company, buying at any price is not a right strategy. You might not lose a lot of money, but there will be huge periods where you will not earn anything. So if you are prepared for that, maybe it's fine. But otherwise, every stock has a price to pay, and you must not overpay. Temperament is the most important quality of a good investor. I think I can't stress more how important it is to have a sound temperament. So let's get to the case studies. This is a graphite electrode company we talk about. So if you see here, during this period, see what happened. Profit margins, which were 9%, OPMs, went to 63%. Now, and before that, they were good, around 15-17%, and then it went to 9%. So one way for you could be, you invest during this period when it was falling from 16 to 9. So that will be the contra-cyclical way, somewhere here. Or in the cyclical turnaround, in between this. Now this is an annual picture, right? If you blow out quarterly, you will see the changes quarterly, and you will see between quarters that things are changing. So somewhere in between here, you could have invested as a contra-cyclical. So you would not have got in at the bottom, but you would be sure that the cycle is done. And in pricing, I will show you how this happened. So this is the period, if you see, this is a period where, it was that at that 9% kind of, margins, which is the lowest you've seen in the decade. And then, then it went to, this 70% kind of margin. Now, so you could have bought anywhere here, this whole period, you would have had to wait for a while, or you could have bought somewhere here when, the cycle change is evident. So there are two ways to it. Here you would have bought at 150, here you would have bought at 500, 750, but still the journey is very, very huge. So either way it is fine. So generally you would want to exit, somewhere here, this period. You may not go and try to sell at the top. So again, if I go back, now the funny thing is, when the price was at 150, the PE was 150. And when the price was 4,500, the PE was only 5. So here, the stock looked optically very expensive. It looked at, at PE of 150. Why? Because the earnings were depressed. It was in down cycle. Here at 4,500, it looked very cheap. It's only 5 times earning. But you have to understand that a lot of these earnings were extraordinary. The point I made earlier, this is a perfect example to tell you, how one makes a mistake by looking at PE. So, so I hope you understand what I'm trying to say. And again, so if you don't, so there are people who would have got in here, obviously, and then they had to, see what happened post once the cycle turned. When cycles are this, this change this fast, and when it goes from 9% to 70% kind of EBITDA margins, they will not last long, is what my experience is. And this is exactly, if you see my Twitter timeline, you will see that, I had said multiple times that, I'm a bit worried that this has gone up way too high, not by pricing, but the cycle has been on uptick, very furiously, and the fall will also be furious. And again, I mean, it's not rocket science, it's just experience. And this is what exactly has happened. And if you see in the prices, see what happened, this one. See, again, these companies are at 0% margin now. Things are changing again. That's a different story. But I just want to bring this example and show you this case study. It's very, very good case study to, basically understand what can happen, where you can go wrong. So again, this is a paper company. I talked to you about, some triggers in paper. This is exactly what happened. You see, this company was making losses, and all of a sudden it started making, 5, 10%, 22% kind of margins, because a lot of supply went in. And see what happens in the price here. The price was 10 rupees and it went all the way to 290. And when the cycle turned, again it will come down. Okay. So you have to understand that this is what is going to happen. So you are fine investing somewhere here or even here. You still make a lot of money. Just don't invest here, is what I would say. So example after example, you will see this. This is the polyfilm company I was talking about. So here, these companies you generally use 17-18% kind of margins, and then suddenly you see that margins have doubled here, and see the profit. Okay, so margins have doubled. The price of the product has doubled. You see, 1200 to 2400. But margins have doubled. But see what the profit went up 10 times, because all this doubling of price directly went to the bottom line. And see what happened to the price. It went up almost 8 times or 9 times. And when the cycle turned, again, it went all the way to 115. Post that, obviously, we had another cycle. This is, I am showing you my first cycle, which I played. Another polyfilm company here. So this is a Boppet polyfilm company. So and this is a BOPP company. So again, the cycles were completely different in this period. Nothing of that sort happened in BOPP, and actually it went down, and then we had cycle turn here. Again, a lot of capacities came in. Again, it went down, and now again demand has been growing all this while. No supplies have come in, and if you see this is now at 12%, and current year it is ended with 17% of margins. Never happened in history, and that's why this stock is currently at 800. But see what happens. This was 50 rupees, went all the way to 400. When cycle turned, it came back to 180, and then slowly this is when cycle turned somewhere here. What we have observed is that 12% is the steady state annual margin or average margin over upcycle and downcycle. So, or rather 12% is the top it would go in BOPP. This time it has been a bit different because a lot of things which the company has done, but again we need to be careful. Here at least you know that any new supply coming in, anybody announces a new plant, it will take 2 years for them to commission, and because of COVID and all that, a lot of people have not done it. If demand stays this thing, we know that this cycle will last for another 1 or 2 years. So you can actually kind of stay here for some time, but you have to understand that those supply might come 2 years down the later, but if announcements are made, let's say in the next 6 months or 1 year, price might peak there. There is a possibility, because markets is intelligent. They know that supply is coming in the future. They will start discounting it right from now. So this is again a metal mining company. It's a PSU. See the margins, the OPMs, and see what happened during this period. Okay. Now something which has always done above 40% went to 11%. Okay. Despite that, this company still made a profit at 11% also. And so if you can understand that this will not last long, because commodity metals, this cycle will not last long forever. And that even in the worst period, this company is making profit. Why? Because it has cash. So a lot of it will be other income, if you see. But see what happened. So during this period, this stock was 90 rupees. Okay. And this company had 80 rupees cash. So whole company you were getting at 10 rupees. Now it being a PSU, you know that there will not be siphoning of this cash, or it will come to you as dividend or only in the future. So again, as I say, this was kind of a low full toss at this point in time. You had very little to lose when it was around this period. It went. So and what happened exactly? Just next year again it went, because this 11% was an anomaly. It had never done that, and if it gives you opportunity like this, that this will not last, and you have a cushion of 90% of the stock value is in cash. Mind you, this company again last year was available below cash. It was available below cash. Now these are the type of investment opportunities you can get, and so basically I generally look for these kind of opportunities, and if I understand the sector very well, I make a reasonable bet in this kind of companies, and it has always plays out most of the times. I mean, 9 out of 10 times this will play out. This sugar again. We see 2015, I talked to you about it. See, these companies were doing 4% margins. Again, see what happened. Immediately next year, it went to 15% margin. And so this is one of the best companies in sugar. So price which was 40 went to 175 again. So there were good monsoons, there was bumper production, you know, supply was more than demand. See what happens here, you know, in just 2 years it comes back to 10% margin. Post that, obviously now it is more of, you know, a lot of ethanol stories going on, and that's a different scenario right now. But for sugar, this is what happens. So if you in the companies, if you look at sugar, the margins will be low. Some companies are doing well because of ethanol. So again, this is another sugar company. So this was the leader. See what happens to the leader. You know, leader doesn't fall much, but it doesn't go up much. So this company went from 40. So during the down cycle, it was 40 rupees. Up cycle, it went to 175. Went up 4 times, right? And then from there, it fell to 60, which is just, you know, it became 1/3 of what it was from the peak. Whereas to the second run company, you know, the rise is also very big, you know. So this typical example, this went from 2 rupees to 75 rupees. And from 75, it went, you know, 15 rupees, which is 1/5. So the fall is also bigger in the second companies. But if you get the cycle right, you can make much more in the second run companies. So that's why I always say that you have a basket. So in this sugar run, my basket had number of companies. One of these was also there, and this company gave me the highest return in the whole basket. So now let's come back to the Aurum Capital small case. We have a product on small case. It's called Cyclical Bets Portfolio. And if you see, I had talked about, you know, 2 strategies. One is, you know, contra-cyclical, and one is cyclical turnaround. This sector will focus on the cyclical turnaround. In this small case, we will look at sectors which have already staged the turnaround, are in the early stages of turnaround, and likely to outperform as cycle improves and offer potential significant re-rating, and where we have some, you know, visibility of slightly longer time, you know, maybe at least you know, 2-3 quarters or 1 year or 2 years. So this is what we have on. We are on small case since March, just 2 months old. We have our product, I mean, on our website since the last almost 3 years. One can visit and see what we have performed over the last 3 years. So here we will be using a basket approach of investing in a particular sector. We look at companies with good corporate governance practices, sustainable balance sheets, and which have survived past down cycle. So this is slightly about the product we have. Again, just 2 months has elapsed, very short time, but this is the performance which the cyclical bets portfolio has had. On the right side, this is the constituent of the portfolio we have. We see the benchmark index is the small cap index, and consistently we are, you know, bridging the gap with the small cap index. So again, very short time, you know, good markets. Markets have been good, so that's why we got this kind of returns. The key thing to understand is that these kind of returns are not sustainable. Obviously, I mean, 26% in 2 months is something which we don't think is sustainable. But yes, what we are looking at is we will. The whole endeavor is to, you know, significantly outperform the benchmark indices. So this is just about the portfolio we have. As I said, you know, it is a very short duration to judge, and the markets have been good. So the risk in this is, you know, we can go wrong if we read some cycle wrong. But yes, we are going to be very nimble in this. If we find that, you know, we have read it wrong, we will cut it. And it will not be just 1 or 2 sectors. There will be sufficient, you know, diversification. So we intend to, you know, minimize risk using this and having 15 to 20 stock portfolio. this was 17 stock portfolio till 2 days back. Now we have brought it to 16. So in the first rebalance, we have removed 4 stocks and added 3 stocks and did some portfolio weight changes. So again, I want to bring this slide here. As I said, this is the place where we will invest in as far as cyclical bets portfolio small case is concerned. Okay. So this is where we will invest, and this is where, or rather here in this is where we will try to exit. Okay, this will be the majority of the portfolio. This is what we aim to do here. Thank you. With this, I end my presentation. If you have any questions, you can put in chat. Okay, so there are some questions which have come in. I will try to answer a few of them. Which sectors have you selected for the small case? I've already put that in the presentation. And I've also put out the performance, so that is answered. Someone has asked, how do you manage to read 5 years annual reports of each company, as there are thousands of listed companies? Well, we don't have to read for all the companies, right? When we select the sector and we select a few plays, we will read, obviously, let's say, we will be reading for those 3 or 5 or 10 companies. And again, since we have so much of experience in the industry, for us to, look at the annual report, and we know where to look, so for somebody who is new to investing, will take a much longer time to decipher the annual report. For us, not because we are experts or something, it's just that we have more experience. We will be able to make sense of that a little faster. So again, what is the expected time frame of investment from small case from which you can expect profits which will beat the cost of subscription? We have already shown you the performance, and for you, we say that at least you should have a sizable capital to invest. Anything you buy should make economic sense, is what I would say. So what was the max drawdown and its period? I mean, we are just 2 months old. We've not had a drawdown, to be honest. But if you go to our website and you look at performance, we have around almost 3 years of performance. So we've had max drawdown in our value investing portfolio, which is there on Aurum Capital, of 40%. Obviously, that happened during last March, but then we stayed invested. In fact, we had some cash during that time, which we invested in April and May of last year. We went to 100% invested, and so the NAV, which was 60, is right now 100 and close to 170. So we have bounced back very well. The max drawdown was 40% last year. I'm not talking about the cyclical small case, because that doesn't have a history of that. So somebody asked example of why P is not good. I gave an example in the case studies. So somebody asked, what are the sectors going through pain now? Again, so that will be in the contra-cyclicals. So something like, for example, hotels, airlines, the exhibitors, they are going through pain. Valuations, one has to look at whether they are good or not. That is a different story. But these are the sectors which are going through pain and will take some time to come back. So individuals, there are some questions about individual stocks which I will skip. So again, somebody asked, what should we check instead of P ratio while investing in such stocks? I have already put that in the presentation. I will be putting that presentation maybe on my blog or on a company's blog. So, and we'll share the link on Twitter. So with this, we will end the presentation. We are slightly past time. So thank you all for joining, and hope it was, there is some learning from this session for everybody.
Thank you so much, Jiten. I know there are still a lot of questions coming. We have a lot of questions today. So, if you have any questions, you can tweet us on tagging smallcase and Jiten or Aurum Capital on Twitter. So please do that, and we'll try to get all the answers. Because even now, I can see a lot of questions are still scrolling up. I think everybody had a very informative session. Thank you so much, Jiten, for coming in. And before going, I just wanted to ask, I always find names to be very fascinating. And I thought we discussed this yesterday and I forgot to say it in the opening. Aurum Capital. Now, I know Aurum has something to do with gold, but why Aurum Capital? What is the philosophy behind that?
So Aurum Capital, I mean, yes, Aurum stands for gold, and our endeavor is to be the gold standard in equity research, and backed by integrity and highest levels of transparency.
Got it. Thank you so much. I believe this webinar was also of a gold standard, an Aurum Capital standard. Thank you so much for coming in, especially taking, again, I can't stress this enough, but taking a Saturday off and coming in to take this webinar session that is really insightful for everyone. And before everybody goes, there is also a promo code, Aurum20, for 20% discount on this Aurum Capital small case. Do check that. The link is there in the description below. Like, subscribe, and share this video so that it helps everybody and brings value to everybody. So let's share knowledge together. Thank you so much, Jiten, for coming on in. We'll see all of you next week at Case by Case by Small Case once again. Thank you, everyone.
Thank you, everybody, for joining.
Yes, and